Hey, welcome to the Aramir Roundtable. Today is the 23rd of September, 2020, and we have Wayne Klump as our guest today. Wayne's up in Seattle. Hopefully you're not um, struggling too much with all the fires and the smoke, but it's nice to have you here, Wayne. You've been in our community for a while, and it's nice to have you as a presenter finally.
Oh, thanks, Tom. I really appreciate it. And yeah, fires cleared out really nicely. Now we're getting some rain. That's pretty normal.
Oh, that's good. You can breathe again.
Yes, yes. It was getting tough there for a little while, but current events, right?
Right. Well, I guess you've got an interesting idea for a trade alert service. It's more geared towards somebody who has, I guess, a larger account who wants to have steady returns and minimal drawdowns, which is very attractive.
Yeah, yeah. I'm gonna kind of get into like how I even came to this area because of course my expertise is in a little bit of a different area, or at least I thought it was until I started doing this, and I go, well, actually everything really applies really well. So but first, before we get into everything, uh, I'm going to go through the disclosure, um, basically saying, Aramir and I are not broker dealers, investment advisors, and that we do this for educational purposes only. And anything that you want to exactly point out on this disclosure, Tom?
Oh, just it's for educational purposes only. Options, futures, and currencies all involve risks. They're not suitable for all investors. Past performance is not necessarily indicative of future results. If you want to read the whole thing, just pause the recording or go to the bottom of any of the pages of Aramir and you can read the whole thing in detail.
And then, so kind of exactly what Tom was kind of talking about is that this is geared towards a certain clientele. Well, the whole thing that started it was I kind of realized that there was this wealth storage paradox in today's environment. And what does that actually mean? What is a wealth storage paradox? Well, in a environment where bond yields are basically zero, or we've flattened out and we've gotten to this hard line of zero interest rates, how do you save money and still get any kind of return or anything? Along with volatility being at historic levels, we recently went through a historic level volatility, and then I know lately we've actually been picking up a little bit. Then with our government printing at the fastest rate in history, I think we printed $3 trillion in a matter of like a month and a half, where it took us, I think, 7 months in 2008 to print that much money. So we're definitely doing that at a record pace right now, and leading to a weaker U.S. dollar, which of course means inflation. That means as U.S. citizens, we pay higher prices for everything. So that means that every dollar that we've actually saved and that is in the bank, especially with 0% bond yields, it's actually less money at the end of the day. And so that's actually this wealth storage paradox is where do we put money? Where do we put cash reserves? Um, where do we place things that we need to save, and still get some sort of return out of it? There was there's the old saying of the 4% rule, and that's kind of hard to apply right now. Is like how do you get a guaranteed 4% and still retire type of thing. Um, so but before I kind of go into everything, let me just lay a little bit of foundation and some groundwork of just kind of who I am, my background, things like that. So I've got a bachelor's degree from University of North Texas. I studied business and behavior analysis. I am a strategy developer and trader. I work with Black Peer Capital. We've been on Roundtable a couple times. I know Ryan's definitely done that, and that's they're fantastic. Fantastic group of guys that I work with over there. Ryan and Tyler are both brilliant. So my specialty is multi-strategy portfolio engineering, and then options on broad-based indices. And I've got this vision that I want to make high-end wealth management accessible to the masses, and that's a really important thing to me is to make sure that everyone at all classes are getting kind of a fair shake at how to manage their money. So I've been on a few presentations, of course, here with Aramir, with Blackpeer. I've been on Chat with Traders, Locking Your Success, and Options Tribe. From those presentations, I got some feedback. And the feedback, what I originally expected was how to maximize return, or I guess the young man's game, as a lot of people say it in this industry, is how do I get the most return possible? How do I reach for the stars, jump for the fences, 1,000%? But what I actually got more of was, how do I keep the money I have while still growing it? More of the um, retirement focused investor feedback. And then also, I kind of got hey, I've got an IRA that's doing nothing. Where do I even start with this? Um, and then, should I just index it? And then, there are issues with indexes. There are great things, and there are issues with indexes. And indexes lately have definitely been trading a little bit more like stocks, just because of the ease of going in and out of them. And so there is there are different things that are going on in today's environment of, well, what are the true answers to each one of these questions? And then I realized that I was facing questions that were kind of revolving around the same thing that I was getting feedback on. What do I do as my wealth grows for my cash reserves? How do I diversify from my trading specialty? Whereas options on broad-based indices and multi-strategy portfolio engineering, that's more of alternative asset-based. What do I do with how do I do something that doesn't take too much of my time? And then, I've got an IRA that doesn't have a permission to trade options, that, to do the headache of pulling it over, but then I don't really want to do options in that IRA. So all these kind of questions started popping up. And then, of course, just how do I manage the cash reserves? There are many times, anyone that trades options, or anyone that trades a really, sometimes a high volatile strategy or something with high absolute risk, you've got cash reserves. We don't invest the whole thing. So, for instance, if we've got an option strategy that does, say 30% a year, typically we keep 50% on the sidelines in cash. And so growth rate, we're doing about 15% a year. Well, can we augment those returns by actually doing something with those cash reserves in a in a in a safer way, or I should say, something that doesn't take nearly as much risk as the alpha generator, which is the option strategy. Well, and then I also wanted to make sure that it wasn't, something that was busy. I didn't want to check it daily. A lot of options trades, a lot of strategies, you've got to check either intraday or daily or even intra week. And I said, hey, this is for the cash reserves. I don't want to do all this. So these are all my thoughts. And so, okay, just kind of walking through my process is, what kind of available methods are out there for these cash reserves? And there's really kind of two main uh, pillars out there. And I think almost everyone recognizes the stock bond. People are really used to this over history, is, the 60-40 or the 50-50, that type of method. And then a slightly newer comer is the risk parity model. And that's where we just normalize volatility across a bunch of assets. And anyways, so we're going to kind of dig into these particularly, just to kind of see why they had merits in the beginning. So that way we can kind of delve into the conclusion of what kind of merits we can make that's maybe even a little bit better than both of these guys. So why does everyone use the stock bond portfolio? What even happened with the 60-40 bond portfolio? Well, there was kind of this fundamental reason that bonds had been uncorrelated in history. And then it also has to do with levers that policymakers use to stimulate the economy. And we're going to get just a little bit into the weeds here, but I promise you we're going to get out of it, because I've got to kind of explain a little bit of how bonds go up and down, and then how they actually offer diversification, and kind of sometimes how they don't offer diversification. So just a little bit into the weeds here. What produces a bond price to go up or down? And what this goes to is that if we're holding a bond, something that's offered, say, at a 10% yield. I'm just going to use some round numbers, right? So a 10% yield, and then current yields drop. So all of a sudden now what's offered on the market is 5%. Well, since we're holding a 10% yield, because we own that bond before yields dropped, when someone comes to buy our bond from us, we hold a 10% and currently offered on the market is a 5%. So people will pay a premium for our bond price over what we originally paid for it, which is a net profit to us. And the reverse goes the same. And so there is sometimes some confusion behind bond prices, but just a simple uh, explanation here is as yields go up and we hold a bond, we lose money. If yields go down while we're holding bonds, we gain money. And so that creates the bull and bear pushes. Well, why do I even talk about yields and bonds, and why do we even go on, why am I even talking about bonds first in a stock bond portfolio? Because everyone really talks about stocks, right? Stocks are the main thing. Well, when I first got into finance, I realized that stocks are kind of like they're like the side child. Bonds are the dog and stocks are the tail. And bonds really are the driver, and why bonds are the driver is because of what we see as modern economic stimulation. So we as a country, the United States, see economics in a Keynesian model. So we believe that cutting rates, and this is all modern economies actually right now, is that we believe that cutting taxes and increased government spending helps stimulate the economy to pull them out of an economic depression. And how do we do that? So cutting taxes and increased government spending, that sounds great, right? And then what does this actually have to do with bonds? Well, first, we've got the policymaker side, which is more of like Congress and president. And this is actually really all current. And we've seen some of these kind of levers get pushed. So you'll probably recognize some of these words. But their main goal, their mandate is to please the public and to please their constituents and get reelected. So how do they do that? Well, if things get bad, they've got to do things to stimulate and make the public happy again. So number one, we've got tariffs. We've seen these pretty recently, actually. So what we do is we make imported goods more expensive, leads to higher prices. And what this does is it really stimulates profit-based things. So businesses, they can charge more for their goods and charge more to the consumer at the end of the day because overall prices are more expensive. Well, then they can also spend money and borrow money from the Treasury. They can increase our deficit, and they can spend on projects and build dams or fences or things like that. That will also lead to more dollars in circulation, which increase to the inflation, right? We can lower taxes, which keeps money that's already in circulation. So instead of taxing it and taking it away from those businesses and those people, we can lower those taxes so that more of that money stays out in the economy and it can stay in circulation. And that increases inflation as well. So pretty much all three of these lead to more inflation. And then we've got the other side of the spectrum, which is the Federal Reserve. Now, the Federal Reserve is really interesting. We created the Federal Reserve after the 1929 issue. And what that goes back to is their mandate is to maintain 2% inflation and full employment. So that's their two mandates that they've got to stay to no matter what. Well, how do they do that? How do they control inflation and how do they control employment? Well, they can lower the federal funds rate, which is used by banks and for overnight credit swaps and other. And what this does is it makes debt as overall cheaper. and it incentivizes businesses to borrow and increase. And what this inevitably does is it increases dollars in circulation. It's a way of printing money, but it's a way of printing money that is eventually need to be paid back in that debt form. So it's not a crystallized dollar. Then what we can also do is we can buy treasuries, or now as of late, it hasn't just been buy treasuries, it's buying junk bonds and other things. So this is where it starts getting into the bond territory. And when we start buying our own bonds, it's a yield curve manipulation. So what this does is it's basically just a digital version of printing money and adding money into circulation and adding liquidity into the bond market, in which all of these things lead to more inflation. So we came down to that since we've been prescribing to the Keynesian economics, we pretty much lead to inflation on everything we do to stimulate the economy, unless we leave the economy alone and kind of let it find its own normal base. But of course, because of all this printing that we've done in history and things like that, we have led to a somewhat shaky system. If we let it fall and we let it kind of find its normal bottom, there are some economists out there that would say that the system can't handle it anymore. So we kind of have to save it every time it kind of goes through this spell. But because the Federal Reserve lowers these interest rates and buys treasuries, and we get these inflations, we get this uncorrelated stock bond relationship. Sometimes they go together, sometimes they rise together, sometimes they fall together. But as long as we've got this Fed that's kind of engineering it to stimulate during downturns, it's a really good thing to have bonds in a portfolio, because when things are going south, typically stocks are going down, and we're going to get a nice boost from the Fed from them dropping interest rates if we're holding bonds prior to them dropping rates. Now, what did this all look like in history, and what did bond yields look like in history, and can we do anything to see what's happened currently? Well, here's a graph of interest rates and stocks over time. So it's a 10-year bond yield. So this is just yields, is in red. And what I want to point out here is that back before the 1929 area, we actually didn't have a federal bank the way that we have it today, or the Federal Reserve that we had it today, where we manipulated the way we did. We started doing that around this time frame after this push down, to try to save the economy from what was happening on 1929. So you can tell, prior, before Fed, we've had some pretty stable stocks for, of course, quite a long time. And then after the Fed, we've got this big push in stocks for a long period of time because of the help that they do when they stimulate the economy. Well, last time, the 1929, last time we got down to the lowest rates in history, or at least near zero, was around this time period. And you can see here that after we got down to these low rates, near zero, right? Of course, we're on this left axis over here. Near zero, which was still not as low as we are today. Once we ran out of, or once we kind of got everything under stability, then after that, what happens is all the inflation that we were talking about from all this stimulation that happened during this time frame, happened over these 10, 15 years, is that we then created this inflationary bubble, right? And this massive inflation that happened over history. And so what happened is the Fed, even though they did drop interest rates a little bit during each economic little spill, overall, they had to ratchet rates up really fast through history. And eventually, I don't know if anyone remembers this, we did get up to, 15 point something on the federal interest rate, which is kind of crazy now that we think of today. Could you imagine buying a house with 18% or something like that, right? I don't think home values could handle that right now. So what this shows is that after an inflationary push, after a massive amount of stimulation and printing and lowering interest rates, it leads to a bunch of inflation. And kind of where I back everything from is a brilliant guy named Ray Dalio. And he kind of talked about recently that hitting the 0% interest rate floor means that the Reserve Bank has almost no effect with their cutting of interest rates or yield curve guidance. So the Federal Reserve at this point, dropping interest rates or buying treasuries in the traditional sense has really no effect. And I think that that's why we've also seen recently a lot of other types of stimulation, like sending checks out. And so we're seeing that other branch that the president and the Congress, they're using their tools as much as possible to stimulate the economy because the Fed's kind of out of gas in its traditional sense. That doesn't mean that they can't, buy stocks or anything like that, or buy other types of assets. You never know what they're going to do because they do need to stimulate the economy. And but as far as bonds go, that's where we got to a pretty big limitation. So Ray Dalio, he's kind of the coin. He coined the all-weather or risk parity portfolio, which is the other alternative that's out there. And that other alternative is really brilliant because it deals with 4 economic cycles. And he looks back at history as far back as he can go in the rise and falls of economies, Roman empires, Great British Empire, of course, the US Empire. And he identified that there's basically 2 variables, and there's these earnings or growth of the economy, and then there's an inflation side. And what he goes through is he talks about that we have how these 2 variables influence each other. Now, as these 2 variables influence each other, different assets are affected differently. And I just kind of threw down some basic generalities of what types of assets work better, but we're not going to get too much into that because that's some really deep into the weeds here. Now, he came out publicly. Actually, Tony Robbins had asked him in an interview. He said, "Hey, what is the all-weather portfolio for the average person out there? For someone that isn't someone that can invest in Bridgewater, which is the largest hedge fund in the world, which is what Ray Dalio is known for." Well, he came out with a static allocation model that he said he thinks can take care of most environments in history. And he said, as long as it's pretty much in this configuration, most environments in history, you'll be okay. And what it goes back to is he's got some pretty interesting ones in here. The fact that stocks are only 30% opposed to the typical 60-40 bond portfolio where 60% are stocks. He's got 30% stocks in it. And then he's got long and intermediate bonds. And we didn't get into the difference between the long and intermediates, but they do slightly affect each other differently. But overall, it's a 55% stake in bonds, which is pretty surprising over time that it should be mostly in bonds. And then we've got commodities up here, which is just a typical, like a commodities index that tracks prices of CPI basically and other commodities. And what that does is it takes care of some inflation. And then gold, which throughout history, throughout all of mankind history, has always been used as a currency. And so instead of cash or something that inflates, he said that really to hold gold as a kind of a cash equivalent. Now, the thing that I had a problem with this is that, he said this would work in most environments. And we had these 2 options that are kind of readily available out here, which was the stock bond portfolio and the all-weather risk parity. And well, what about like right now? In history, he said most environments. Well, okay. What does he say right now? Well, right now, this is a recent quote from him that this is like the 1930s and 45s in which you'd be pretty crazy to hold bonds. And I think that goes back to exactly what he's talking about is this spot right here in history where we've had a massive amount of printing and bond yields dropping down to zero, and it led to inevitably a large increase because the Federal Reserve has to maintain its mandate, which is that 2% inflation. So it can't let inflation go too high. Now we can change how we calculate CPI. We can change a few other things to maybe make it look like it's not inflating as much so that we can temporarily not raise interest rates. But inevitably, that's what they have to do, is they have to hold interest rates. Otherwise, we lose the dollar reserve. So what else did he say? Well, he's saying that recently, investors should favor stocks and gold over bonds and cash. Now, over the last week, of course, that we've had a small correction in stocks and we've had a small correction in gold. But over the generality since he said his first quote, it would have been actually really favorable if we were in those types of assets back in April. Well, what's really interesting here is that as of recently, it has been shown that Bridgewater, which is the largest fund in the world and runs the all-weather portfolio, has actually been moving into gold and inflation-linked bonds. Well, if we've got a cliff in front of us and we know it, right? We know, okay, throughout history, this is just what's happened after large amounts of stimulation and yield curve guidance and bond buying from our central bank. Should we just see the cliff and just go right off it? Well, I'm sitting here thinking all the questions that I asked myself. What do I want to do with my IRAs? What do I want to do with my cash reserves? And I didn't get a good feeling from this at all. I go, I can't handle a static bond stock portfolio. Well, then the static risk of 55% bonds as well was kind of plaguing me as well. But I'm like, okay, let's look at this and let's see throughout history, or at least over the last years, what it looked like, and really kind of what we're dealing with a static portfolio. And just to kind of go over just some really kind of quick stats here is we've got the all-weather, or we got the stock index that's in yellow. We've got the all-weather in blue, and we've got the 60-40 in red. And that's 60% stocks, 40% bonds. So we can kind of see how it performed over the great financial crisis, how it over some of the debt crises, the flash crash, the debt crisis, 2015 area, and then of course what happened here recently. And for the most part, we'd look at this all-weather portfolio and we'd be like, well, man, it's super underperforming. At the same time, if we would have looked at it, back in 2013 or so, we would have been like, man, thank God we had the all-weather portfolio. It's only been as of 2014 really where we had some underperformance. And well, why is that? Well, we only drew down at our maximum 16% in the Great Financial Crisis, or the Great Recession, whereas stocks did 50% and a 60-40 drew down 30%. And we had quite a few years span where we didn't make new money or have any kind of growth. And what if I don't have a time horizon that's okay with that type of drawdown, and for that length of a period, something that's more steady like an all-weather is a little bit more appealing, even though I'm giving up some growth. Now, I'm giving up some growth, but I'm still doing 7% on an all-weather portfolio. Now, is the environment today the same as what it has been over this data set? And that's where I kind of ran into an issue, because there's something that's called curve fitting, which is where we basically move our allocations around and we kind of tweak them to match the data set that we have and say, hey, if I would have had that over this time period, it would have been the greatest return. Look at it. It's amazing. Well, if anyone's familiar with sitting here looking at, okay, yeah, if I would have done this over the last, it should work, going forward. Well, it doesn't always work out how we expect. Sometimes it goes down a, flaming ball of fire, and sometimes it works relatively close to what it was, but it takes a lot of moderation and trying to fix it in a more adaptable approach. And it normally takes definitely some human intervention to figure out what's going on and what's different today than it was over the data set. Well, all of this kind of stormed and brewed into something that really, with all of our financial technology, all of the ways that we can do things at our fingertips from our phones, and retail investors can just be powerhouses now. A retail investor has way more power today than it ever did in history to get in and out of assets, to trade at a spec, and to be able to work a full-time job as well. Well, but we're still left a little frustrated at the end of the day, because how do we use all of this financial technology in the right way? How do we get some growing assets? And what's out there, like at least what's publicly known, it just doesn't always fit the bill, and there's some excess risk in there. And especially when things are a little bit different today than they were back in history, or maybe they are the same today that they were back in history, but of course that was 60, 70, 80 years ago. And what if I wasn't alive back then? So I didn't know what I know today, type of thing. Well, and there's a better way to do it. I really truly felt that there was a better way to do it. And so I wanted to sit there and kind of go through, okay, what are my must-haves? And this is where we go through, it needs to have the economic cycles. It needs to have a self-adapting risk portfolio, something that instead of these static allocations, it morphs to sit there and go, okay, where are my risks today? What do I need to be in? Where are these assets risky today? Do I need to hold them in my portfolio? I think it's got to have the power of ETFs. The power of ETFs is phenomenal nowadays. The fact that a retail investor can invest like a hedge fund used to is just incredible. And I believe that it's got to be simple. I don't want to sit here and think about it every day. I don't want to have to worry about it all the time. It's got to be sit there, I can just punch it and kind of forget it type of thing. And it's got to be long only. A lot of IRAs, I've got a couple that, short selling and options, I don't want to do in that IRA, or I don't want in that IRA, or I can't because, that institution. From all of those must-haves, what came out of it was the Sleep Well portfolio. And it's a portfolio that is self-adapting based on risk. It uses simple buy and sell orders on high liquidity ETFs. It limits the amount of positions to achieve the maximum efficiency. And it's only once per week updates. So I don't have to look at this thing every day, or intraday or intra-week. And then it also requires no additional analytics software. I'm a visual person, so in order to kind of understand something, I like to see an equity curve. I like to see what things look like, where the risks are, them at least in a data set that's familiar with me. So here's an image of what the Sleep Well portfolio looks like since the with the Great Recession in mind. So here, things that I want to point out are that the Sleep Well portfolio, since it's constantly self-adapting itself and it uses broad ETFs and different assets, it can sidestep large economic turmoil because it can use other types of assets other than the primary stocks in it. It's not that static portfolio that we look like. Same thing in the flash crash right here. It definitely performed drastically different than what happened in the debt crisis. And then we can also see that over the last few years, we have matched the performance of the S&P, just like we were back here where we were matching the performance of the S&P. We did have a little area here where the S&P caught up to the Sleep Well portfolio. And then as of recently, where we had this huge spike crash, the COVID crash. It's just probably what we're going to call it from now on, the pandemic. We barely got phased by it. So instead of drawing down around like 36%, we only drew down about 8, I think. So that was a huge point for me, was that I wanted something that was stable, that I didn't have to worry about, and that if we have these large economic things like something that happened in the Great Recession, or even as of recently, that I didn't have to stomach those drawdowns. I didn't have to stomach those areas or those years and years and years without hitting new highs. And for the statisticians out there that look more at the stats of things, here's some basic stats. Now, we're going to look at everything from the compound annual growth rate over to the right, because to the left, we're going to get into that in just a little bit. So we had a 9% gain, or we had a 9% annual interest or annual growth rate over the last 13 years or so. We had an average drawdown of 2.49%. We had a maximum 12-month return of 24% in this data set. And we had an 11.5% maximum drawdown, as opposed to that 50% that stocks had, and then that 30% that stock bond portfolio had. This is our weekly upside standard deviation, so just kind of getting a feel of how much it moves up or down. We can pretty much expect it for 67% of the time, or 68% of the time, to have a 1% move to the upside or a 1% move to the downside in a weekly basis. But we should be able to have 58% of the time have a positive gain. Okay, so that's all fine and dandy, but you know what's beautiful about modern instruments is that, well, say I've got different goals for my investing, and it's maybe not so primarily based on safety. It's more on growth, or I'm okay taking extra risk, or I've got a small IRA that I just want to max out type thing. Well, because these ETFs are big, broad ETFs that are very common, high liquidity, they offer leveraged versions of them. Now, why would we even talk about leveraged versions, right? Leveraged versions can blow up, those types of things. You know, there are risks to leveraged versions. But what's nice about leveraged versions when using a multi-asset portfolio is that multi-asset portfolio limits the amount of risk and drawdown, and maybe we can use that as a lever if we're okay with that type of risk. So here's an example of leveraging just a couple of these ETFs to attempt to match what the S&P's weekly volatility is. And so you can kind of see here, this is a little bit more volatile than our previous one. And that's because we have leveraged a couple of these, but as you can see here, we are taking about equal risk on a weekly basis to the S&P without taking all of the economic worries that we have in the S&P, because we're not primarily driven by stocks, we're more driven by assets and the flow of money. Now, of course, if we're really, really gung-ho on some risk and we're okay with taking excess risk beyond what the stock market has in it, then of course there are maximum leverage versions of these ETFs which max out at 3 times on some of these, and we can push this a little bit further. Now, over this data set, these are some pretty large numbers, and this is a logarithmic graph, so of course it doesn't kind of do it justice, the difference between here and here. But this is a pretty substantially large gain, and if we look at the statistics of these leverages, and so what I did here is I put the leverage amounts on each one of these, and so that way we can kind of dig through what the compound annual interest rate is, and then just kind of what our general expectations would be going over time. So not to spend too much time on leverages, just because this wasn't originally what this was designed for, was maximum growth, albeit we can use that. Let's look at a couple times in history of what the allocation portfolio kind of did and how we moved our assets in. So right here, we've got the COVID crisis, this recent one. How does the Sleep Well portfolio kind of navigate these types of environments? Well, prior to, we were pretty heavily in gold and the SPY, and we didn't have much in bonds, and we had a little bit in small caps, and then nothing in emerging markets over here, and then nothing in deflationary products. So this is EUP is a deflationary product for it's the dollar versus all the other currencies globally. It tracks the dollar index. So what happens is as we get closer to COVID, right, and as we're getting in here, the flow of money was pulling us into more bonds and more and staying steady in gold, a little bit in small caps here and there. And then pretty much once the crisis actually hit, the pretty much first down leg was the last hurrah for stocks, and it pretty much pulled us completely out of stocks and small caps and pushed us into gold and bonds, which then as the federal interest rate dropped bonds, we benefited from that for this last time around. And then we pushed out of gold and we started going into some deflationary products because the US dollar was actually deflating. So that's why the Federal Reserve was so quick to just drop interest rates and everything, was because the US dollar was actually under attack. We were getting some deflationary pressure on the US dollar, and that's their mandate, is they need to maintain inflation. Now, we wouldn't have known that unless we had something like this where we were starting to see those pressures. Or unless, of course, you're a Forex expert. And Tom, I know your Forex is your forte.
Well, it's one of them. Yep.
So yeah, I mean, so to go through this, and then of course we came out of this and we started getting into stocks a lot more as we started to get the money flow patterns that pushed us into that. And then of course we finished off pretty strong into emerging markets, gold, and stocks. And that was back in June. Now, what about the great financial crisis? You can kind of see that it kind of worked the same way. We actually were pretty much out of stocks, at least at the beginning of this, which is from this first arrow. And then we were mostly in bonds, gold, and deflationary products as the Federal Reserve was doing more and more to try to keep it going. And then at some point in time, we actually got maximum exposure directly into gold, which is kind of an interesting parameter. But this portfolio can concentrate us if other assets are that risky. We've basically deemed, hey, the volatility in these assets, the performance, all the metrics that the Sleep Well takes into consideration is saying that these assets are incredibly too risky, and gold is the benefiter from this environment. And then we slowly phase out of gold, or we phase out of gold pretty quickly, jump into bond stocks, and then we of course start to even out, and we get some more exposure into stocks by the end of this. So by in May right here, we are pretty much gung-ho on stocks because those are the powerhouses, while bonds, gold, and deflationary products and emerging markets were actually still having a very tough time at the bottom right here, after the money flows were coming out of them and going back into stocks. We were just kind of following along. During a normal bull market, you'll see that we pretty much stay, when stocks are performing really strong, we'll be in stocks or bond, will be stock, bond, emerging markets, and we can shift around, and we go into some bonds and gold in some areas just to give us our nice stability. We can split up over some assets. So some other uses, just like I was talking about, maybe myself not being a Forex guru, we can use this as a, kind of a macro indicator of inflation and growth and how asset money flows are moving around the world. We can also use it as a position size director, which is, hey, maybe I've got a trading system that has positive correlation to the S&P or to gold. And hey, that asset in the Sleep Well is pushing us more into S&P or pushing us more into gold. And we can use that to increase our trade size type of thing. Well, what that comes down to is that we've got an alert service that Aramir and I have partnered up. And what it comes out to is I wanted to add as much value as possible. And this isn't meant to be, this is meant to be something that is done with, cash reserves and can make an enormous amount of money with some relative safety. And I wanted to do that for as much value as possible. So we have came to the conclusion that a nice $50 per month to get this service. And if you are actually a previous subscriber to anything that Aramir already offers, it will be 20% off, or $40 a month for those current subscribers.
And that includes gold members or any alert service.
That's awesome, even for gold members.
Yep.
Okay, and also something that I am a advocate of is that I'm trying to add as much value as I can, and I want to add value to other people in the world and maybe less fortunate, and especially during the last crisis that we have that don't have the finances that we have in America. And so 10% of all the profits that I make off of this are actually going to go directly to charity. And that's going to go, currently I use Give Directly, and they give money directly to some of the poorest countries in the world. So with that alert service, you will get an alert every Tuesday starting September 28th. And you'll get a monthly webinar that I will host through Aramir, and we will go through the details of how the portfolio has shifted, some macro, and open up to, of course, any questions that are kind of going on, and how things are performing. That's going to be on the first Wednesday of every month at 5 p.m. Eastern, or just something easy to remember it by. It's an hour after the market close. And something that's also really nice about this is that there's no software needed for this. In fact, I've made a sheet, which I'll explain in just a second here. But if instead of jumping into some systems where we have to buy analytics software or something like that, that analytics software is relatively expensive, and that's a nice savings, which is really nice. So instead of a software or something that's needed as far as an extra expense every month, I decided that I'd make a sheet that was really easy to manage this. And it's the sheet that I use. I've been using this for quite a while now for myself. I just kind of tweaked it just a little bit so that way it's really easy to use for anyone. And the sheet, just simplicity, kind of looks like this. We've got, so that way it's really easy to follow along. We've got our NAV, we've got our different assets, and then we've got kind of previous and current allocations and some nice macros that kind of help us shift see what our allocation is shifting to. And then my alert will actually come out to how this actually changed. It also has a little sheet to track once we archive each allocation throughout history. It'll actually track the NAV as we update it, and we can kind of track our portfolio performance over time. So that was the Sleep Well management sheet, and I just want to thank you for your time, and hope that everyone sleeps well, and I can open it up for any questions and any curious endeavors that go on to this and anything that goes up. Tom, can you help me out with the chat, or if you have any questions?
Yeah, well, Lloyd had a question. Do you have a chart showing your allocation changes and the prices of the ETFs?
I do. I do not have that on this presentation or anything like that. But if you reach out to me at my email here, I can definitely get that to you if you have a specific time frame or something like that that you wanted to see.
Okay. And then I was curious, I was thinking a good way to keep that sheet updated. Do you update that every week kind of thing, or?
I do update that every week, yes.
Because we could make a private forum for the Sleepwell subscribers, and then you could just update and make it a sticky thread in the forum and just update it every week.
Yeah, that'd be perfect.
Yeah, okay. Easy peasy.
Awesome. Hey, you're the software guru, right?
Well, I'm not bad at it, yeah.
Yeah, that'd be fantastic, and I think that would help people out a lot too.
All right, well, let's see if there's any other questions. Looks like there's a few. John asked, how do you determine when to change allocations and by how much?
Yeah, that's actually exactly what the Sleepwell is doing. Is that through its metrics and through its risk models that I developed, it is going to determine how much of an allocation shift. And that's what the alert is coming out with every Tuesday is this is how much the allocations are shifting, and this is the allocations that we currently are in.
Okay, and then Scott asked, what are some of the metrics used to determine allocation?
Yeah, so different variations of volatility, price, momentum, and then also this is where it gets a little bit kind of different than just the typical ones where it looks at single assets, is it looks at how they're behaving from one another and what that balance looks like. And that's really where the kind of the secret sauce came into. And of course I say secret sauce because of, this is my career's work that uses these types of metrics.
Okay, Eli asks, when there's a downtrend shift that occurs fast, how fast does your system change its allocation? Will it be given only on Tuesday?
Yeah, so it is meant to be something that we kind of, let go and we don't think about intra week. So just like there are many trading systems out there that we check once a day, and there are some that work intraday depending on the amount of risk that they take. One of the fastest drawdowns that we've seen was something very similar to what happened in excuse me, let me just cruise through this. What happened right here in the COVID? I mean, I don't think we've ever had a 30% drop in stocks. I guess 1929 would probably be pretty close. Um, but the whole thing is that prior to big drops in the stocks, things are already getting weaker. Things are already starting to shift, and so it's actually picking up on that well in advance that we needed to start phasing out of certain assets and start going into some certain safe havens and things like that, just because the balance of the assets were starting to become off kilter. So it's still, no matter what, it will only be once per week check-in. And the reason why I used it once per week instead of a typical allocation shift, which is once a month or once a quarter, is because if the allocation has us shifted into 70% gold and 15% bonds and 15% UUP or something like that, I don't want to hold it for a whole quarter while everything shifts back out. And so that's why I did make it every week, and it is significantly fast enough to catch most economic swings while still taking some risk. It's not exactly going to completely eliminate to where we have to check this thing every day type of thing.
Just curious, what's the minimum you would recommend that people would need to trade this effectively?
That's a great question. So with 1x leverages and the ETFs, it's easiest at anything over 10,000.
Okay.
It gets a little bit more incremental just because the SPY has gotten pretty expensive over time periods. So of course 300 and something dollars per share. That's what makes it a little bit less incremental. Albeit the interesting thing is that I have a really small IRA that I use this in also, and I use leverage versions of this, and it's way easier to use the leverage versions because they're smaller. There's the shares are around 50, something like that.
So if you wanted to do a leveraged ETF, what would you say the minimum would be?
I've done it as small as $1,000,
Wow.
and it is not perfect. So I would probably say we'd want to stay somewhere around the $2,000. But you still are going to run into some small incrementability, and it depends on the leverage as well. But yeah, that's about as small as you can make it happen.
Okay, and that leads into Serge's question. Will this portfolio service include the leverage ETFs?
The sheet that I use, or that you're going to get with the alert service, that sheet has all of the leveraged versions that are currently available. Doesn't mean that they can't change or anything like that. And it's not a recommendation to use any one of these or anything. That's not what I'm saying. But the allocations will not change whatsoever. And what you can do is the allocations aren't going to change. So the alert service the alert that comes out will say, hey, you need, or it'll say that, hey, I'm in 20, I just moved into 20% SPY, 30% stocks, blah, blah, blah. And what that'll do is that it won't change how much we put no matter what our leverage is. It'll just say, hey, instead of using SPY, I'm going to use the 3X version of it. And then there you go.
Okay. And then as far as when exactly would you send it out, and when would subscribers need to make changes to their portfolio? Would that be a Tuesday at the open, the close, or how's the specific? How would you do it?
Yeah, exactly. Actually, before the open, I'm going to send out the alert for what the allocations are, or what they're going to be in. And then what I'm going to do is that when the open comes around, of course, I'm moving into them, and then I'll send out an alert of what actually got executed.
Okay, so you'll tell them in advance what you're going to do, and then what you actually did after it's filled.
Correct. And something just to know here is that to check validities of things and make sure that certain slippages and the robustness of this system is that I've actually tested this with having a 2-day lag on it to execute, and it still performs very, very closely to exactly what the expectations are. So, as close as you can get to execution is perfect, the day of, but there's not a lot of pressure behind it. That's what I'm trying to say there.
So if you put a signal out Tuesday morning and somebody's working and can't get to it till later in the day, they should still be fine.
Correct. Because these are huge, large based ETFs that have tons of assets underneath each one of them, it makes it to where they don't drastically move, just diabolically intraday. Now, during higher volatility times, economic crises, those types of things, it probably behoove you to be a little bit closer to time frame. So instead of 2 days lag, maybe that day. Yeah, exactly. It would be a lot better.
Okay, sounds pretty simple.
Mm-hmm.
I don't see any more questions, so I put the link up there. I didn't see it in your presentation. It's just aramir.com/sleepwell. And that'll take you to a page with some basic information about it. At the bottom, there's a link you can sign up if it's something interesting for you. If you're a gold member or a current subscriber to any other alert service, I'm going to be sending a coupon with a link that you can use to get that 20% discount.
Awesome. Thank you, Tom, for partnering up with me and really kind of getting this out there. And I really look forward to helping everyone manage a growing asset portfolio. It's a really exciting time. And thank you very much for your time.
Yeah, thanks very much. Thanks everyone for attending, and I'll get this posted and I'll send out that email as soon as I can to all the current subscribers, so if you want to take advantage of it. And if you don't want to wait, just send me a message and I'll send it to you right away. So thanks, Wayne. Really appreciate it. And yeah, hopefully everybody takes advantage of it. It's a nice way to sleep well at night with your cash reserve, right?
Yes. Nice.
Okay. All right. Thanks, everyone.